G'day, Woody. How are you?
Good, man. I think it's been a while since we got on a Zoom call and had a chat.
We have. You know, you've been a busy man, so that's fine.
Well, so have you. So have you. And you've been away. You've seen your new family in Europe, and we've not really properly caught up since then. But I trust you had a good time.
Oh, we had a great time, mate. Yeah. It all puts life into perspective when you see this new life and little granddaughter, our first granddaughter or first grandchild, which happens to be a girl. So it was wonderful, mate. It's refreshing.
Oh, it's lovely. And what I guess we're in proper bear market territory at the moment. So I thought that's why it's a timely thing to get Mr. Vern Gowdie on for a Friday insider chat.
I've got to shake that thing of I'm on this perma bear.
No. I know you're not. The thing is, the reason why I wanted to get you on too is because I was reading your latest update that you sent to the Gowdie, and there is actually a solution at the end of it, what you're actually doing. So we'll get to that. So I understand you're not a perma bear. I do have some questions a bit later on about when you will turn bullish, but let's end on that one and not start with it.
Okay.
But the thing is, this week you kicked off a series basically where you'll be exploring the dangers and the challenges of the coming months. And this is part one that was released this week. But I just wanted to read out a paragraph where you say you touch on a few things, but I thought we could start there because it kind of sets it up pretty well. So you wrote, for reasons we'll look at in this series, brackets, the US recession, the coming slump in US corporate earnings, US corporate defaults, the negative impact a stronger US dollar is having on Europe and Japan, it's highly likely we've entered a period where portfolios are going to be seriously stress tested and many are going to fail. In my opinion, we're on a pathway to a severe global recession, and it's likely to hit in the first half of 2023. Now, you've highlighted a number of causes there, but you also say it's going to hit in mid-2023. Is it not hitting already?
Well, yeah, you can see that it depends. You know, there's an old saying, you know, the definition of a recession is when your neighbor loses a job, and the definition of a depression is when you lose your job. So there's certain parts of society that are really feeling it. You know, you read about the rental crises and this sort of thing, and people having issues to deal with there. So and the energy costs. You know, so, and that's not so much in Australia, but I do know in places like the UK, like my daughter, her energy bill's gone from £70 a month to £200 a month now. You know, so there's these little pockets of stress that are within individually, but collectively, you know, that it's not showing up just yet. It's, you know, there's been a bit of froth blowing off the top of some of the portfolios. If you've had what they call a quality portfolio, you sort of blue chip shares and bonds and that sort of thing. They've gone, obviously, if you've gone all in on some cryptos or that, your pain's been much worse. But in general, so it's there, and you can, and you know, but it hasn't really hit to the point like, and until you've gone through like the GFC, you know, when it was at its worst and people were really panicked, and, you know, banks were getting, you know, people going into banks asking for their money and these silent bank runs. We're not there yet. They're not there. So it's just this sort of feeling at present, and some are feeling it worse than others, but it's not a collective mood just yet.
Yeah, you mentioned the official definition of recession, but it feels like we're kind of in one. Like, why? And you also mentioned that the financial authorities, namely the Fed chairman Jerome Powell, they're not admitting that we're in a recession right now. Why do you think they're doing that?
Oh, it's the old confidence trick. You know, I don't. You know, our current treasurer, he was hauled over the coals for saying, "Oh, things are going to look bad," because, you know, that dents confidence. It's all about maintaining confidence. So therefore, they're just trying to use weasel words or different ways of trying to say, "Hey, this is not as bad as it is." And because I also think those two negative quarters were minus, you know, point something. They weren't -1 or 2. They weren't a whole number. That may have given them a bit of wriggle room, but it's just a stay of execution. It's coming, and you know, then they can't avoid the reality of it all. So I think at this stage, that's why if they go like this, it's not there, they can still keep going on this interest rate path that they appear to be committed to. But I think that metal will be tested as well.
Yeah, you also mentioned that no investor feels the loss of wealth effect more than one who has borrowed to participate in a booming market. Now, do you think any recovery from recession won't really be able to happen until all that leverage is worked out of the system? Or will it take an event like the GFC for that to happen? In which case, 2023 will be pretty interesting, right?
Yeah, very much so. Well, yeah, in the context of what I said there, it was a graph that's put together by Advisor Perspectives, and they overlay in real terms, that is inflation adjusted terms, levels of margin debt within the US financial system, and then how that tracks with the S&P 500. And in all the previous bubbles we've had, the smart money, those who have borrowed to ride the wave up, but know that this is not a permanent trend, start to exit a month, 2, 3 before the S&P actually starts to peak. It's an interesting phenomena in that they tend to go out beforehand, and that from studies I've read tends to be the first leg that we see down. That is that's the little bit of hiss you hear coming out of the bubble is the people who are borrowed saying, I'm out of here, I'm going to take my money off the table.
And has that been happening, Vern?
Oh, it's happening. Yeah. In that graph, you can see it. The trend is very evident. The margin debt in the US peaked in around about, I think it was October last year, whereas the S&P didn't peak until later in December. So yeah, margin debt levels were coming off about a good 2 months before the S&P 500 actually peaked. And again, this happened in 2007. You know, the margin debt started to peak around about July, and then it started to come off. Well, the S&P peaked in October, December 2007. The big crash was later in 2008, but the peaks from where it turns down. And the same in 2000, prior to the dot-com busting, margin debt was exiting the system a couple of months before the S&P peaked. So it's a unless it's a pure coincidence each time that this starts to happen, there's a pretty clear trend. So that's the first leg. So that's what we've seen, and then that goes out. So that selling pressure goes out, and that's the recovery we had. This dead cat bounce we've had since June or July, where people think, the worst is over. It's back on. But now we're coming to the second leg, which is earnings. So to answer your question, I think we've got to go through a GFC type of event and that seems to be where the world is now heading to. And this next leg, based on history of markets, is going to be where you have earnings disappointments. And in that article you're talking about, I talked about, the headline about FedEx coming out saying, hey, it's not looking good. And these are
they've just downgraded their earnings forecast, haven't they?
Yeah, and saying, I think the CEO was saying, and these aren't his exact words, but words to the effect, we're going into a global recession. That's what they see coming. And you don't need to have there's enough dots being put out there that you can join about, be it energy crises, food crises, the currency issues that Europe and Japan are facing with the stronger with the stronger US dollar, where they've got to buy commodities in USD. So the cost of that energy is going up, not just because the cost of the commodities gone up, but now because of the exchange rate. And there's a lot of anecdotal or evidence out there to suggest, the times we've had are well behind us. We are now entering another more difficult phase, and now overpriced markets are going to be robustly tested.
Well, you were saying just off camera before we hit record that so the FedEx is the latest one, I guess, but then that you were saying about earnings and sales from tech behemoths like Apple, for example. They've been giving further indicators, right?
Yeah, that's something I've just been reading yesterday. Is And this goes through like the S&P and the more so, but they, there's a few stocks that have just dominated the capitalization of that index, and it's a conversation I had with Dan Denning for the Gowdie advisory about how the generals are the last to fall in this, and these are the big ones. Well, now the data I see yesterday that Apple. Their sales of iPhone 14 or whatever it is, whatever the latest one is, I'm not into these things, is not disappointing. They're not to the level that the sort of pre-orders indicated they would be. So they've actually, I think Foxconn is one of their major suppliers or manufacturers. They've actually just told them to put 5 of the production lines on idle in their, one of their Chinese factories. I think I had its name here somewhere, Zhengzhou factory. So so that's sort of, again, people buying less iPhones. So what's that going to do to Apple's earnings? And then Amazon, it was in Bloomberg, I think yesterday, the day before, they've just put on ice or cancelled the existing and planned about dozens of them of warehouses. So the obviously that business is, people are just rethinking their budgets and households, and will they keep buying this stuff? So maybe they were planning to open up more of these warehouses to satisfy the demand that they saw that was probably COVID led, and now that's not there, and people are now trimming budgets. So that's another indicator. And then I think it was in the Financial Times, I lose track of days, but it was just today or yesterday, about Glencore, the big commodities trader out of Switzerland, that their major seller or distributor, the major distributor of copper in China, what's it called? Maike, M-A-I-K-E Metals, has just got liquidity issues. Now, they handle something like 80% of the distribution of copper in China. And these liquidity issues have been born from what's happening in the property market over there, and also the broader economy, the slowdown. So little by little, this stuff is feeding its way up. And it's a saying I heard a long time ago: if you kill the plankton, you kill the whale. And so, as the smaller little households feel it, gradually it works its way through to the upper end. And now we're starting to see that in various corners of the globe, and what's facing Europe this winter. And we see that pipeline now, that gas pipeline that's somehow busted a gasket overnight. What's that going to do for Europe? It's already in a world of hurt, and what's happening to the euro, mate? It's just coming at all fronts.
Do you think this is so? Do you think this is like more like I know each recession and downturn is different from the previous one, and that's why they're hard to predict. People could predict, but you tend to know it's cyclical. But would you say we're more in a situation like we were coming out of the dot-com bust, is it more of the GFC type thing that we're playing into? Because the dot-com was tech sector really, but it wasn't necessarily a credit crunch situation, which is what happened in the GFC. Or do you think what do you see, Vern? Do you think the big, because the big kahuna, the GFC, was when global credit just completely dried up? Is that the sort of thing we're heading into? And it's just going to take one trigger? I know it's a bit of a convoluted question, but
yeah, I'll go back and I'll ramp up to your question, and I've written about this in the past, is that you look back, and I've used the US wealth to household ratio as a in the articles I've written about, and you can actually see it. You can see the dot-com bubble. The wealth to household income ratio gets up. It's historically been around about 550-560%, and it got up. So you see this little tick up, the bubble bursts, and it comes back down to what is a natural equilibrium for wealth to income. So then you see the US housing one, it gets up higher, and it too comes back to 560. And this one is now it peaked at about 800 and something percent, so it's got to come off. But you look back, and because I've lived through all this, I looked at it and think, well, this is, the first one was a sort of a one generational, one asset bubble. That is, it was mainly boomers, and it was a dot-com, the tech sector, which then by definition lifted up the other shares. The second one started to bring in the Gen Gen Ys, are the next ones after the boomers, X's, no, Gen X's, Gen X's.
Yeah.
And the boomers. But it was a 2-asset bubble. That was a housing and share market bubble. So therefore net wealth increased. This one, we're now, 14 years or 13 or 14 years further down the track, and it's a multi-generational, multi-asset bubble. This has got, boomers, it's got, chasing yield, it's got the Gen X's, who are in there, and then you got the millennials, because of the cryptos and all this other thing. And so you've got nearly everyone is in the everything bubble. So it's gone to this level, and then there's so much artificial wealth that's being created, and people think they have this value or this net worth, which really isn't there. So when you talk about a GFC type event, whether this, and I'm actually just in the process of writing about it, whether this is actually going to be a short, a real painful type deflation of the bubble like it was in 08, 09, or whether it's going to be long and protracted because of the sheer size of it, I'm not sure. But it's going to make the GFC look like a Sunday school picnic by the time it's over, because expectations have been built up across multi-generations and we've all been, and this whole idea of a diversified portfolio is going to be proven to be nonsense, because everything other than cash, and probably to a lesser degree or to some degree gold or precious metals, have been inflated. The bond markets have, benefited greatly from this because of the decline, the reduction in interest rates, capital rates go up. You've had your crypto stuff, you got the shares, you got private equity, you got housing. Everything has been lifted up, and I don't think people truly understand the extent of what's happened, and the fact that if those assets have been beneficiaries of this easy money policy, then they've also got to now become the victims of it, and it's going to be painful, because this is a bubble like nothing we've ever seen in history. The valuations.
I'm going to ask you what you're doing about it in a moment, but just one more question, and it's more specifically for Australia. Where do you? A number of people are pretty bullish. I know prices for everything tend to fall in a recession because demand goes down. But, the vast majority of our economy, I know a lot of our household debt is based in the housing market, but obviously we're the biggest exporter, one of the biggest of resources. Do you see, and you mentioned, say, one of the biggest Chinese suppliers and producers of copper.
Distributors, yes.
Is that going to affect the supply of these critical resources, and might that be a positive for Australian resources industry, for example?
Well, if China, joining all the dots it can be a bit difficult, but China did save us after the GFC. They went on a spendathon and drew in all this. Hence, we had that commodities boom, or the mining boom and that sort of thing. I don't see that they've got the capacity to do that next time. I think they'll be more focused internally, trying to keep things steady there, because if they no longer, if their property market's sort of imploding, or their corporates have got to pay back US debt in a depreciated currency point of view, they're going to have a lot of internal issues, because they too have been party to this whole debt financed bubble. So I don't see that they're going to be the white knight that they were in 2010 onwards. So absent them, where else is it? It won't be Europe. It won't be America. So
what about the big push to green energy and net zero and all the? There's that argument out there that in order to hit these ludicrous targets by 2030 or whatever, and the sheer amount of minerals you need that needs fossil fuels, by the way, to be mined, to mine them. You need an awful lot of these minerals and resources to build that infrastructure out, and those things like batteries and EVs and stuff like that. What are your thoughts on that? Wouldn't that be one of the things that could?
Yeah, that could be another source of demand for the goods we have. It just depends on how much money governments are going to throw at that, because if you're in the private sector, the cost of renewables or getting this stuff is expensive.
It's astronomical.
So you can't. So therefore, if all of a sudden your portfolio is worth a lot less, or you have unemployment going up and people are getting these big bills, then what do you do? How do you? So do you do what Britain's done and say, oh well, no, we'll underwrite that and borrow £75 billion, so we can put a suppression on your energy costs, and then the debt market, the bond market goes, oh man, and the currency market tanks. So nothing happens in isolation. So this linear progression of what the green energy is going to do and this zero is, I think, markets have ways and means of, things change, and it could be public opinion could just completely rotate and say, we can't afford this. You guys need to ease up. This is just hurting us too much. And you go back to what the UK have now done and saying, they're going to go back to fossil fuel energy sources, or you're going to burn wood like they are in Germany, or you're going to reship coal, so you may see that this green agenda, which in my opinion has been born from complacency and now contempt for the economic model that has delivered us to here, that, a great growth has just been this assumed thing that we're entitled to, but it's all been done on the back of debt, low interest rates. So we now have such contempt for the economic model and the industry behind it that got us to here, and the energy production sources that got us to here, that we think we can just treat it. We can do this. Well, maybe the system will turn. So I don't take a linear progression with the green stuff. I think it's what did Kerry Packer say? An intellectual wank that may, that is an indulgence at the end of a super cycle of debt. And maybe there's a whole shift within society's attitudes.
Well, you do say that in your issue this week in part one, that markets are not linear, they're cyclical, and that's the whole point, right? But so talking of cyclical markets, then how? And I know you don't know yet as to whether it's going to be a really big sharp drop or whether it's going to be a long protracted grind lower, while the authorities or the financial authorities try to do it in a more easy way because everything's so blown up. But is there a level that you'd be looking at to start getting a bit excited about certain assets? I know, for example, your dollar cost averaging into gold and silver and things like that. But they're going to go down in the short term too, right? I mean, they're going down now, especially gold.
Well, yeah, that was one of the reasons I actually held off on the gold and silver recommendation until a week or two ago, because my concern has been that, like it happened in 2008, is that people don't realize that the gold price fell about 30% in a matter of months, because it got caught in that whole downdraft of selling. And there's various theories as to why that happened. Could it be people just wanted to cash out? Could it been people, corporates or countries with US dollar denominated debt thought they can get rid of a US denominated dollar commodity, a liquid commodity, to get that to satisfy debt obligations? There's a whole host of reasons, but as to why that moved, but it did move. It got caught in that selling downdraft, and it could have just been a rush to liquidity. So I suspect that, we may see the same again, or we've seen a little bit of that. Whether there's just a point where people go, no, that's low enough for gold, and we'll start buying again. So that's the reason why I've adopted a discipline of dollar cost averaging. We'll put a little bit in here and then another little bit in, and hopefully you're buying in that bottom 10-15% of the air, with the view that this is a decade-long hold. The value of what is being done now, it's a bit like if you sort of bought in 1932 or something like that, the real value of that didn't probably happen and see the benefit of that for 10 or 15 years afterwards. You just bought well, and you just have to be patient for people to get over the scarring, the psychological scarring of what they'd been through, for enough people to forget and go back. I think so that's where I think. So that's what I've done with the gold side of things. As to what will be a point to trigger the rest of it, I don't know, because I've looked at three scenarios here, and again, that's all the going from history of great bubble bust. One was the Great Depression, or the 29 collapse, and that was sort of done and dusted nearly 90% in about 2.5, 3 years. The second one is what happened in the US and the Australian market, and people don't realise this, from about the mid-60s to the early 80s, is that the market just seesawed.
Yeah.
For about 15, 16, 17 years. It just did nothing. Well, it did a lot of up and down, but the real buying, it didn't come for about 10 years from when and I've just done it today, the US peaked in about 65. The real buying was until about 1974. That was the real bottom of that. So you could have bought it about 600 or 700 points. I think the Dow was about 1,000 back then. So that was nearly a decade you had to wait to get the bottom of that market before it took back up again. And then you got Japan, which is another debt-fueled asset appreciation that was across property and shares. And that took 20 years to find bottom, from 1990 to 2010. You know, it lost 75, 80% of its value. So the markets can find a myriad of ways to grind their way, or to get their way back to an undervalued, from a seriously overvalued to a better value position. So as to when, I don't know, because I alluded to it earlier, Woody, is that I'm not sure. Like, Powell talks a tough game at present. Oh, I'll step into Volcker's shoes and I'll be the big man and I'll do all this. Mate, I think he's got a spine of jello. And when it really gets tough, and he can handle the Dow going from 30 to 29, and then you're going to wake up, and it's going to, and I'm fairly certain it's going to happen. You're going to wake up. There's going to be an event, and I call it the Lehman moment. But it's something that's building to it as the stresses within the system just finally people go, someone's going to go. It's going to be a corporate or a sovereign, and someone's going to just go, I'm out of here. And it falls, and that's going to trigger things. That's when we'll see what he's made of, when that sort of panic is out there, and okay, this is just the market working its way out. We'll just stand back, and we'll be committed to getting this inflation. So I'm thinking they will blink, and that's when they will go, all in. And it could be just pure political pressure. You've got to do something. And so that's why we could get this seesaw effect. We could drop 30 or so percent and then zoom and then back down again, because really they're just providing some sort of band-aid solution that doesn't get rid of the underlying rot. So that's why I can't answer definitively.
Oh no!
What will be the base case?
I also know you can't, but I wanted to ask anyway. But you're going to reveal more of the strategy for the dollar cost averaging and the assets you're going to choose in the next part of the series. Can you give us an inkling when that's going to be?
Well, that's next week.
Next week, is it, or the week after?
That, but no, next Monday it'll be out for the Gowdie letter. But yeah, it's really just the methodology behind the strategy. And one of the things I spoke about there is it's being able to maintain your composure. People if you haven't been through this sort of stuff, and I went through 87, 2000 and 08, when everyone thinks they're thinking now is good, but when those markets start to tank and things start to get stressed and strained and what's happening, people lose composure. Their judgments get clouded. So the having a disciplined approach and also having a good hefty cash component enables you to maintain that composure, because while people are losing their money, they're also losing their judgment as well. They tend to panic. So and that's what part of this discipline will be about. So that's why I'm going to talk about why we're just working our way into the gold position and silver. I think silver is something that people haven't really looked at. and I did a bit of research on that, or quite a lengthy article on the ratio of silver to gold and why that's out of whack at present. And just how we manage the rest of our cash exposure. And I sort of alluded to that today, is that which pathway, there's 3 doors this market's going to go down, and which one is it? But
I guess we'll wait and see. All right, well, I'll wrap it up there, Vern. That's really good catch up, and I'll look forward to part 2.
Yeah, mate.
Maybe we'll have another catch up when that's out, and we can update people.
Okay, no, look forward to it.
All right, thank you, Vern.
Thanks, buddy. Cheers, mate. Bye.